similarities between cost accounting and financial accounting. So we want to look at what are the similarities between cost accounting and management accounting. Number one, we have periodicity of reporting. 2, accuracy is maintained in both systems. 3, the results of the business is revealed in both systems. 4, vouchers and we have vouchers and invoices forms the basis for recording of transactions, for recording business transactions. Number 5, we have fundamental principles of double entry is maintained in both systems. So these are some of the similarities between cost accounting and financial accounting. We have periodicity of reporting. In cost accounting, periodicity is more frequent than in financial accounting, where in financial accounting we have reporting done either semi-annually or yearly. But in cost accounting, it may be done weekly, monthly, or on yearly basis. But in both systems, we have that periodicity of reporting. Then we have accuracy of accounts being maintained. In both systems, we ensure that there is no biasness, there are no mistakes, errors, or omissions. So accuracy is maintained in both systems. Then number 3, we have results of the business revealed. The intention is simply to know whether there is any profit or loss being made, or to know the financial position of the business. And therefore, in both systems, we have results of the business being revealed. Note number 4, vouchers and invoices form the basis for recording of business transactions. They form as part of the books of books of subsidiary entries, which help in like creation of any other account. So we apply that in both systems. Number 5, we have fundamental principles of double entry. Whenever we are passing entries in both systems, double entry principle must be applied. So those are the similarities in the two systems. We move on to part B of the question. We are told that Rengo Limited has provided the following data for the financial year 2022. Number 1, we have budgeted output for the year, which was 9,800 units. Note 2, we have standard details for 1 unit. Under that, we have direct materials, we have direct labor costs. We've been given variable overheads and fixed overheads. So required, prepare a standard cost statement of unit, cost showing prime cost, Roman 2, variable production cost, Roman number 3, total cost, and Roman number 4, selling price per unit at a notion profit of 15% on cost. For you to be able to answer this question, you need to understand what you need to consider, especially pertaining the data that you've been provided with. The question requires you to compute the total cost, but in that total cost, you need to show the subtitles. Prime cost, show the variable production cost, the total cost, and the latter show the selling price. So the best way of answering this question is simply preparing what we refer to as the cost sheet. which will enable you to show all the costs in card, get the total cost, and then show the selling price. So this will be computed as follows. This is Rengo Limited. Note number 2, we are told that standard details for 1 unit direct materials is 4 square meters at 530. So to know the amount for that particular, for the raw materials, we are simply taking that quantity and then you multiply by the price. So we'll have 40 meters times the price, which is 250, which gives us 10,000. Then we have direct labor. We are told this was incurred in 2 departments, so we have bonding cost center. The quantity is 48 hours. You multiply by the price per hour, which is 250. Sorry, this should be 530, not 250, 530. So we calculate this. This should be 21,200. This is 12,000. Still under direct labor, we also had another department which is finishing cost center. The hours used were 30 hours and the price per hour is 190. So you simply multiply 30 hours times 190, which will give us 5,700. So add this. This is 17,700. In our part 1, we were required to show the prime cost. You now show the prime cost. Prime cost is simply the total of direct materials, direct labor, and direct expenses. So since we do not have direct expenses, the total prime cost will simply be direct materials plus direct labor. So this will amount to 38,900. So you've already answered part 1. In Roman number 2, you are told to calculate the variable production cost. So we now calculate variable production cost. When you look at note number 3, we are told that budgeted costs and hours per annum. Variable overhead, you've been given hours, and then we have shillings. So we have bonding cost center. Hours were 500,000 and the amount is 3,750,000. So we have not been given the cost per unit. For you to calculate the cost per unit, we do what we refer to as calculation of an absorption rate, which is simply based on the cost that is given divided by the number of hours that have been given, and that will give you the cost per unit. And therefore, in the bonding cost center, to calculate the cost per unit, you are simply taking 3,750,000. Then you divide that by 500 hours. You divide that by 500,000 hours. And then we were told that it is related to direct labor. So the direct labor hours that were incurred in the bonding cost center were 48 hours. So once you get the cost per unit, you now multiply by the number of hours that were incurred in that particular department. And this will give us the cost per unit for that center. So when you calculate you'll get 360. You do the same for finishing cost center. For cost finishing, we have 1,500,000 shillings. We are dividing by 300 hours to get the cost per unit. Then you multiply by the number of hours that were incurred in the finishing department, which was 30 hours. This will give us 150. Then you get the total. And this is 510. And that's part 2 or Roman 2 of that question, variable production cost. Then we move on to Roman 3. We are to compute the total cost. Still on that note number 3, we were given fixed overheads. So we are to calculate the fixed overheads. And under the fixed overheads, we've been given the amount for production. And remember, in note number 1, we were told that budgeted output for the year was 9,800 units. So to get the cost per unit, you are to take the production amount of 39,200,000. Divide this by the number of units that were produced, which is 9,800 units. Then multiply that. Sorry, we don't need to multiply, and get the cost per unit. So calculate that. This will give us 4,000 shillings. We also have selling and distribution, fixed overheads, and the amount is 19,600,000. Divide this by the number of units that were produced, which is 9,800 units. Then divide that. So this will give us 2,000. And then lastly, we have administration. Administration overheads, the amount is 9,800,000. Divided by the units of output to get the cost per unit. And this will give us 1,000. Then get the total, which will give us the total cost. So we are adding from 38,900 plus 510 plus 4 plus 5,000 plus 5,000, which will give us 44,410. So that is the total cost. In Roman number 4, the question requires us to calculate the selling price per unit at a notion profit of 15% of cost. 15% of cost. So we already have the total cost of 44,410. We need to calculate profit, which we are told it is 15% of the cost. So calculate 15% of 44,410, which will give you 6,662. And then from there we now get the selling price, which is now the total of the cost plus the profit. And this will give us 51,071.5. This will be the selling price. So that's how you want to answer part B of question number 1. We proceed on to to part C of the same question. We are told that Jumbo Limited manufactures bracelets for export trade. The sales revenue is dependent on level of advertising expenditure per month. The company has recorded the following sales information for the past 6 months. So we've been given the information about advertising expenditure and sales revenue. And then we are told that the following has been calculated. So you don't need to calculate, the figures have already been given. Then required, estimate fixed and variable elements of the sales revenue using the least square regression analysis. To use least square regression analysis, you need to know how to determine the values of A and B. And therefore we have a formula which we use to calculate the values of A and B. So the regression formula is as follows. Sum of y equals NA plus B sum of x, and sum of xy equals A sum of x plus B sum of x squared. So these are simultaneous equations which must be solved together, and the intention is simply to find the values of A and B. So we have already been given information. We are told in that question that sales revenue is dependent on the level of advertising. Whenever you are answering this question, always be able to identify the independent and dependent variable. So the question has already interpreted for you what is the dependent variable and what is the independent variable. We have advertising expenditure and sales revenue. You've been told that sales revenue is dependent, meaning the sales revenue is our y variable, which is the dependent variable, and advertisement is the x variable, which is the independent variable. Under that table, you've been given the values. So what we need is sum of y. Remember, we are saying that sales revenue is the dependent variable, and dependent variable is abbreviated by y. So sum of sales revenue is given as 192,000. So just reduce the zeros based on the table that we've been given above. So we'll have 192 shillings equal to, N is referring to the number of observations or items that we have, which are already listed, and there are 6. So we have 6A plus sum of x. What is the sum of x? X is referring to independent variable, which is advertisement. You are given sum of advertising expenditure, which is 13.5. 13.5b. So this will become our first equation. Then we move on to equation number 2. We have xy, which is referring to advertising expenditure times the sales revenue, which again we've already been given. So this is 147,000.25 equals sum of x, that is sum of advertisement, is 13.5a plus sum of x squared, that is advertisement expenditure squared, which is 32. 0.125b, and this will become our second equation. So from there we solve the equation simultaneously. We want to eliminate a. So to eliminate a, we must make values at a equal. To make equal, simply cross multiply. We have line 1 being multiplied by 13.5, multiply line 2 by 6. And remember that 6 and 13.5 is affecting all other values. So you multiply 192 times 13.5, which will give us 2,592. These are shillings, equals 6 multiplied by 13.5. This is 81a plus 13.5 squared. This is 182.25b. Do the same for the second line. We are multiplying all the figures by 6. So 147.25 times 6. This is 883.5, which will equal to 13.5 times 6 will give us 81a plus times 6. So this times this will give us 192.75b. Then you subtract. We are using elimination method. Subtract the values. So we are using elimination method. This should be 447, not 147. So 447.25 multiplied by 6 gives us 2,684. So we then subtract the figures. 2592 minus 2684. This will give us negative 92, which will be equal to, this is a 0. Then 182.25 minus 192.75 will give us negative 10.5b. From there, our intention is to find the value of b. So we divide both sides by negative 10.5. Divide both sides by negative 10.5. So b will be equal to it will be equal to 8.76. 8.76. So once we find the value of b, we now use that to calculate the value of a. So regression analysis equation is in the form of y equals a plus bx. And so for us to find this a, we are to use the first equation because it has smaller figures. So we'll have 192 equals 6a plus 13.5. We already have the value of b. Replace that with 8.76. Then you solve it. So we have 192 minus 118.25 equals 6a. So 73.74 equals 6a. Then we divide both sides by 6. Therefore, a will be equal to 12.29. And that is the value of a. So the question simply required us to find the value of fixed and variable elements of the sales revenue. So what are the fixed? In this equation, y equals a plus bx, a is referring to the constant, which is the fixed cost, and b is the variable cost. So we've already calculated the value of a and the value of b. So b is the variable cost and a is the b is the variable cost per unit, and a is the fixed cost, and that is what was required in that question. Thank you and bye bye.
Part B of the question reads as follows. S and M are advocates operating under the name SM Advocates. The firm's trial balance for the year ended 30th June 2022 is as shown below. They are talking of costs charged to clients through to capital. Of course, the trial balance has been given and it is balancing at 1,518,000 and also 1,518,000. Additional information. It's estimated that debts amounting to 16,500 are uncollectible and should be written off. Depreciation, that is number 2, depreciation should be provided at the rate of 20% per annum on the book value of the furniture, fittings, and library books. The uncompleted work on 30th June 2022 was valued at 70,500,000. Required statement of profit or loss for the year ended 30th June 2022 and the statement of financial position as at 30th June 2022. So this question was under preparation of financial statements from other entities, and more specifically it's about professional firms, and this is a firm for advocates. So we'll go straight to the first part of the required, that is Roman 1, SM Advocates, SM Advocates, statement of profit or loss, statement of profit or loss, statement of profit or loss for the year ended, for the year ended 30th June, for the year ended 30th June 2022. Great. So shillings, cost charged to clients, that is the same as professional fees. So we are going to use as it is, costs charged to clients, same as professional fees, 750,000. Add work in progress carried down. A work in progress carried down is the same as additional information number 3, and completed work, that is 7,500. Less work in progress brought down. Work in progress brought down is the same as the work in progress balance brought down on the trial balance, 110,400. So this one is going to be deducted. So that is 750,000 plus 70,500 minus 110,400, 710,100, 710,100. That is like total income. Total professional fees for that period, less expenses, less expenses. The first expense is office expenses. Office expenses. The office expenses amounted to 25,500. 25,500. Postage, telephone and internet. Postage, telephone and internet. So postage, telephone and internet amounted to 54,600. 54,600. Printing and stationery. Printing and stationery amounted to 105,000. Printing and stationery. Rent and rates. Rent and rates 180,000. That has been given us 180,000. Salaries to staff. Salaries to staff 216,000. Salaries to staff is 216,000. And finally, the expenses on the trial balance have been exhausted. We move to the additional information number 1. There is irrecoverable debts. Irrecoverable debts. Irrecoverable debts amounted to 16,500. And finally, depreciation, which is being provided on furniture and fittings, and depreciation is at the rate of 20% per annum on book value. 20% per annum on book value. So we have the figure of furniture, which is of course at book value. So that is 20%. Times the value of furniture is 135,000. 135,000. That will give us 135,000 times 20%, 27,000. 27,000. Once you have the expenses there, it is 25,500 plus 54,600, 54,600 plus 105,000 plus 180,000 plus 216,000 plus 16,500 plus 27,000. This is 624,600. 624,600. And profit for the year. Profit for the year. The profit for the year is 710,100 minus the answer 85,500. 85,500. So that was the statement of profit or loss for that professional firm during that particular period. That takes us to the statement of financial position. SM Advocates. SM Advocates. Statement of financial position. Financial position as at 30th June 30th June 2022. As of 30th June 2022. So we have assets, or before assets we can bring in the two columns. And non-current assets. Under non-current assets, we have furniture, fittings, and library books. Furniture, fittings, and library books. Furniture, fitting, and library books. Now let us compute the book value for the same. The cost is 135,000. Remember, the cost was 135,000 minus depreciation, which we've computed as 27 minus 27,000. That's the depreciation that we even computed in the statement of profit or loss. The book value is 108,000. 108,000, and that is the only non-current assets. Current assets. Current assets. We have the first one being work in progress, carried down, work in progress at the end of the year. The work in progress at the end of the year, in additional information number 3, was 7,500. We have receivables. Receivables amounted to 234,000. 234,000. Cash at bank. Cash at bank. Or before we record cash at bank, receivables is to be affected because there was irrecoverable debts. There was some irrecoverable debts, so this one is going to be reduced. So that is 234,000 minus the recoverable debts of 16,500. 16,500. So that is 234,000 minus 16,500, 217,500. 217,500. Then there is cash at bank divided into 2. There is client and there is office account. Client account and office account. Client account is 74,400. Office account is 167,100. 167,100. Any other current asset here? We have disbursement on behalf of clients. 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 36,000. 36,000. Disbursement on behalf of clients. 36,000. So the total assets. Total current assets 7,500 plus 217,500 plus 74,400 plus 167,100 plus 36,000 565,500 565,500 565,500. Total assets. Total assets plus 108,000 673,500 673,500. From that point we move to capital and liabilities. Capital and liabilities. and we have capital. The capital account stood at a balance of 612,000. Add profit for the year. The profit for the year was 85,500 less drawings. Drawings amounted to 180,000. Drawings amounted to 180,000 and they are to be subtracted. So that is 612,000 plus 85,500 minus 180,000, 517,500. Non-current liabilities. Non-current liabilities, and non-current liabilities were not there, so it's going to be nil. Current liabilities. Current liabilities were given as follows. We have clients for monies held on their behalf. So clients for monies, clients for monies held, of course, on their behalf, for monies held on their behalf, amounted to 74,400. 74,400. Creditors, 81,600. Creditors, 81,600. Total is 74,400 plus 81,600, 156,000, which gives us the total capital and liabilities. Total capital and liabilities, which is 517,500 plus 156,000, you get 673,500. 673,500. So, learners, that is how the question was supposed to be handled. That is for financial reporting August 2022 question 4, which combined lease accounting IFRS 16 and also professional firms in financial statement of other entities, and more specifically professional firms. See you again in our other subsequent revisions. My name is Nicholas Sikali.
Hello learner, welcome to Manifested e-learning platform. My name is F.A. Mlingwiri, and today, ladies and gentlemen, we are discussing about the business and data analytics August 2023 paper. The question of focus today is question 22. It reads as follows. Riziki Limited is considering a project with the following details. Initial cost 40 million, residual value 2.5 million, selling price per unit is 1.1, variable cost per unit 500, I meant 1,100, pardon me. The variable cost per unit is 500, fixed cost per year is 5 million. Additional information, annual number of units sold is 30,000. The project has a useful life of 5 years. The company uses a weighted average cost of capital or WACC of 12%. Required, A, compute the base net present value. B, carry out a sensitivity analysis of NPV assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital. C, prepare an appropriate chart to indicate the different NPVs for each scenario in B above. Note, Adverse variances in this case means a decrease in cash inflows or an increase in cash outflows. So what we're going to do, ladies and gentlemen, you can see towards the right of the screen over here that we've developed inputs: the initial cost, the residual value, the selling price, the variable cost per unit, and the fixed cost per year, and the project life there. So what we're going to do then, we're going to now identify the inputs, or the major inputs towards the right. Like for example, what I mean is this: we are going to now talk about the base. Here we're going to talk about the base case, input based on the input, so base. That, and then towards the right, we're going to include a 5% initial cost, or positive value of 5% initial cost. So we're going to have plus 5% initial cost, like that, and then we will now then have the adverse scenario where we have negative 5% annual unit sales. So negative, I'm going to do like that, negative 5% annual unit sales. So with that, we proceed on to get or to also identify now the 5% selling price. So negative 5% selling price. Then we continue building on the model itself. Right here we have variable cost. Now, increase in variable cost. 5% variable, 5%. I'll explain variable cost. And then we're just following these components right over here. So we began with the initial cost, then we went to the annual unit sales, then the selling price, then you're going to the variable cost over here of 5% variable cost, and then residual value there. So negative 5%, negative 5%, 5% residual fixed cost. I think I forgot fixed cost. So positive 5%. Apologies for that. Positive 5%. 5% fixed cost. And then we're talking about residual value right here. Residual value. %, residual value. That. So with that, we are saying that we are told to compute the NPV. So the inputs, then we just follow the inputs based on whatever we've been given. So the residual value right over here, we can come to the initial cost. You can see the initial cost is 40 million over here. So it's 40 million. We're just doing the base case scenario over here. So what I can do, I can put this perhaps on that side like that. So that now, and maybe perhaps I can, with your permission, I can just compress it a bit over here like that, so that you can be able to fill out this part. So the initial cost right here, you can see is 40 million like that. So 40 million and we come down there. So we want the comma format, guys, the comma format. So we highlight everything, put a comma, then just like that. So here the initial cost plus that value there. Then we have the residual value are going down. The residual value is given to us over there, that value there, because we talk about the base case. And then the annual unit sales. The annual unit sales you can see is right here, additional information number 1, so 30,000. So just put plus 30,000, because this is in words, it's not separated from the words, so it's in figures combined with the words. So just put 30,000 there. We have the selling price per unit given to us. The selling price per unit, you can see, is given to us on the right here. So enter that. The variable cost per unit as well, given to us there. Enter. Then the fixed costs per year have also been given to us there. So plus, enter there. The project life in years, we have been told in note number 2 that the project has a useful life of 5 years. So we just indicate here 5. That. So what happens then when we have an increase on initial cost? So the increase in initial cost will be, you can put 5% over here, because we're saying it's going to be 5% increase over here. So you put just 5%, and we increase. So this will all require this to have a percentage. So allow me to do this, to do the following, to put this as percentage over here, comma format here, that. So don't worry about this. These are just the marks that are being allocated towards the entire question. So you can see it's 30 marks over here. So with the permission, and I can just do away with that. Or rather, I can just put them beside the questions over there. However, I can just do away with them for now. So with 5% increase, we just come over here, plus that value times a factor of 1 plus, we're increasing it by 5%. That's what it gives us, 42 million. With 42 million, we are saying the residual value remains as the way it is over here, because we're saying that the residual value will remain as 2.5 million all through, whether there is going to be an adverse effect or so on and so forth like that. So here is 2.2 million, like that. We proceed on, and even the number of units, this will be the same. The annual unit sales will be the same, 30,000. Here we are saying it's going to be 1,100, like that. So I can just copy these values as the way they are towards the right there, with your permission. Because we are saying that the initial cost is the one that is only increasing. So here, just a copy, paste special values. And I say okay, that. So if that's the case, what happens when we have a decrease in unit sales? 5% decrease in unit sales, because we're saying from the question right here that carry out a sensitivity analysis for the NPV assuming adverse variance of 5% for all the inputs except the project life and weighted average cost of capital there. So we are saying that now we want to put adverse effects over here. So we are going to have negative 5%, like that. You can see it's even indicated to us over here. So here we are saying is going to come back now back to this, because we're saying we increased it from this to this based on the 5%, but now it's going to come down. And so I'll increase now each of these items moving towards the right there. The annual unit sales, the selling price, the variable cost, and so on and so forth. So that now, right down over here, we can now do the workings effectively. So, you can say plus that value times 1 plus it should be because you're decreasing this value over here 1 no so this is the formula, it's plus that value, we're decreasing it by 5%, so it should be delete plus this value, and then we're multiplying it by, open the brackets, 1, decreasing it means, so it's going to be, we're subtracting it from 0.05, so 1 minus 0.05, that. It shouldn't give us 1 minus 0. We took about 5% adverse effect, because we're saying from here, if we increase this one by 5%, so then decreasing it should be able to give us them. It should be able to give us take us back to where we actually were before, were there. So it should be just 40 million. That. And with 40 million, then we are saying that we can move ahead and say that variable cost is going to now also selling price the variable cost is going to decrease over here. So we put negative 5% in terms of selling price, sorry. So negative 5%. So we put that, and it remains the same. Over here I'll explain that. If you're talking about the variable cost itself, also, it also remains the same like that. So it's going to remain, including the residual value, like that. But what we're saying is that here we will need then to put 5%, because we're saying it's 5% variable cost, 5%, then negative 5%. Because it's positive there. So we are saying what? That in terms of the initial cost, if it's going to increase, it's going to increase by 5%. If the unit sales decrease by 5%, then it's from this increase, it's supposed to decrease to 40 million back again. Then what about the residual value? The residual value should remain the same, with the exception of the very final residual value down over here. So it should remain the same here. So we just maintain it like so, up to there. But you're saying that the very final one over here is going to, this residual value is going to be plus that value times, open the brackets, 1 plus should be that value there. The residual value represents an inflow of money when you sell the asset. So we are saying that at this point over here, the residual value, a 5% decrease in residual value will cause it to be over there. That. So that's what we have. We proceed on to discuss the next item, talk about the annual unit sales. The annual unit sales will affect what? Will affect this component right over here, this column over here, the annual unit sales. So here we are saying it's going to decrease, so plus that one times, open the brackets, 1 plus that 5%, negative 5%, 28,500. But the rest remain the way they are. These other values remain the way they are. So 30,000. So plus sorry, pardon me for that. So it should remain 30,000. That should remain the same. Control R. It's only the unit sales. Why? Because you're saying that the unit sales are the ones which are being affected. The sales, we're dealing with unit sales. So this annual unit sales component should actually change. Next item is the selling price per unit. So what would change? So selling price per unit, this is what is going to change. That part there is going to change. Pardon me. That one is the one that's going to change. So here we are saying it remains at 1100. So here we are saying it's just going to be that, because it has already changed. This one remains the same, but the selling price changes based on that component there. So we are saying the selling price is going to be plus that one times, open the brackets, 1 plus selling price comes to 1045, but the rest remain the way they are. How about the variable cost per unit? Variable cost per unit remains the same with the exception of the variable cost component. So here we expect it to remain the same. So we drag it up to there. But that value times, open the brackets, 1 plus the variable cost is increasing. 525, then the others remain the way they are. The fixed cost per year. The fixed cost per year, we are saying is going to be 5 million with the exception of the fixed cost component. Or just put it like so, up to there, Control R. So this one is just going to change plus that value times, open the brackets, 1 plus that value, and we enter. Then we remain with enter. We will have it like that. How about the project years? The project years remain the same. We've been told it's 5 years, so it goes without saying that it's going to remain 5 years. Just leave it like that. And with that, now those are the inputs that we've worked out. We now want to proceed to work out the solution. So the unit sales, we start by identifying the unit sales over here. Unit sales, over here we have, and of course here we have the base case given to us there. This one should be slightly above here because we do not fill in. So base case. That. Then here we are saying we are going to now put in the figures. The unit sales, 30,000. So we have them there. And then we copy these components towards the right here. Copy. Towards just the right here. Database, just the same way. Then we have the initial cost is going to be how much? We're just going to copy and pick it from there. So the initial cost in terms of the unit sales is just going to be the same. You can see that because you're talking about the initial cost here. So when you're talking about the initial cost, we're just going to copy it like that. So enter. So the initial cost, we just pick it over there, just from above over here, because the initial cost is going to be an increase. So then the annual unit sold. So we just then autofill, Control R, with the exception of this one where we're saying the annual unit sales changes over here. Remember how we did it over here? Is what we're saying actually changes there. The next component is the selling price. Selling price. So we move like so. Selling price. Price. And the selling price or SP is given as plus that value. Enter it like that. Remember where it changes. It changes at the point where we have the selling price component there. So if it picks from above there, so just put it like so. You can see the selling price changes at that point here. Next component, next item is the total sales. Total sales. And you're saying the total sales is going to be given as we multiply you're just going to pick the values here given to us over here. Total sales plus from the question, just to clarify over here. One second. I get it. It's just going to be this value of here, selling price, times that value. That's what we're getting. Sorry. And once we have that, we proceed on to identify the next component there. And with that, we're saying we'll just be able to just pick the values, dragging them over here. Sorry, I was just having a bit of a small hitch. Sorry for that. So Control R. And you can see what happens there. We just pick the selling price and then we multiply with the unit sales. So what happens then now with the next component? So those are total sales. Once we have the total sales, we pick the variable cost per unit. Variable cost per unit. Sorry. Per unit. And the variable cost per unit given to us there is just going to be 500. You can clearly see it, it's just given to us over here, 500. So we just pick it. Remember, we're just picking the values the way they are over in the base case. Enter. And you remember the variable cost component changed at this point. Remember, it changed at this point here where the variable cost was actually increasing at 5%. So it changed to 525. So we just move towards the right and then Control R. How about the total variable cost? So here, with your permission, I'll just move this a bit towards the right. Over here, I can say variable cost, total variable cost. Total variable cost. And the total variable cost will be given as variable cost in terms of shillings times the units. Put towards the right, Control R, and it picks. Once we have the total variable cost, we can be able to pick now the sales in terms of the variable costs, the sales variable costs, so sales. Variable cost. Sales variable cost. And we can see that it is just going to be the total sales and then we add the total variable cost. That's what we are going to do. So it's going to be the sales, which is there. Then we add that value. But there's one thing. The variable cost is a cost. Please note. So what we're supposed to do is that we're supposed to put this in form of a negative sign there. So apologies for that. Put a negative. Put it like that. Then I move it towards the right there. So that now we can be able to indicate or be to show that it is actually indeed a cost. And so you can see the sales variable cost actually changes there. So now what is left is for me now to just drag it like so. Please note one thing, that the unit sales were given to us there. The selling price was also given to us there. The total sales is just the unit selling price times the unit sales. The variable cost per unit, we had already computed it right above over here, and we say that this variable cost component over here is going to change by an increase of 5%, increase variable cost. The sales variable cost right over here is just given to us as the total sales minus variable cost. So the sales less variable cost gives us this value here. How about the fixed costs? The fixed cost is given to us there as follows. 5 million. It's right here. So we enter, and because we're saying it's a cost itself, so let's put a negative sign there to show that it's a cost. Then we move towards the right like that. Remember, the component of fixed cost over here changed, 5,250,000. So we're putting it a negative over here just to indicate that it's a cost. And with that, we can be able to then identify the cash flows. Cash flows. So the cash flows we have over here are just going to be 18 million, and then we subtract 5 million. or we add. Why I'm adding is because we need to, is because we're going to subtract. Please note. So we're going to add. If I subtract, it's going to be 18 minus minus, which comes to plus. So you should be able to just add it right there. So get 13,000. 13 million, pardon me. So 13 million, Control R, move towards the right. And those are the cash flows. But remember one thing, that there was a residual value over here that we didn't factor in. So we just put it in there. So the residual value year 5, so we can put it year 5 is a cash inflow. So how much? We pick those residual values from up above here, please. There. Then, because there's a change in residual value over here of 2.375, we need to factor that in. So Control R, but we do not subtract it. It's a cash inflow. So then we are going to, or we'll need then to get the present value interest factor. So down over here we'll have PVIF, present value interest factor, year 1 times cash flow, Which cash flow? These ones here. So we'll do the same, PVIF year 2 times cash flow up to year 5. So year 1, year 2, so I'll just change this. It's going to be easier to change that. Year 3, year 4, then year 5. Cash flow there. And how do we get the present value interest factor? We're just getting the present value interest factor. Could put the interest rate right above over here. So interest rate, it's at 12%, all through 12%. So here we put that, then we 12%. So it's going to be plus the cash flow and then we are discounting it. Discount it against, open the brackets, 1 plus that value, close the brackets, power 1 times, not times the cash flow, it's already been multiplied like that. So we enter. So once we have that, we shift Control R. That is year 1. Notice that I've done over here, you can see even the formula, it's power 1. So here I'll do power 2, power 3, power 4, and so on and so forth like that. So because I want the cash flows, it's going to be plus that value over 1 plus that one, power 2, that. Then you do the same thing. One plus R power 3 like that. So here is going to be this power 3. Yes, power 3. So power 4. Sorry, I was just having some trouble with the mouse. Sorry. So plus the cash flow over, open the brackets, 1 plus power 4, that. Then finally we have power 5, but we will also need to work out the residual value right here. So the residual value, the cash flow is going to be plus that value over 1 plus power 5. Enter. So Control R. Then we have what is called the residual value. Residual value. So you can say PVIF, value interest factor, year 5, times cash flow. That's what you do. So this is residual value. I should change this to enter, just to do that. And we're saying that the residual value was what value? Residual value was that one over 1 plus that value, power 5. Please note it's power 5 because there's a cash inflow that is coming in at the end of period 5. Just to confirm that it's okay. Yes, that's okay. So from there, we get the total PV. And I can just be able to indicate it using a bottom border, thick border, the bottom, thick border at the bottom there. You can say that we're getting the total present value. Present values is going to be those ones there, like that, up to there. Then I just drag it towards the right, Control R, it gets the total, and I bold that, Control B, as well as this one I Control B, like that, to show that that's the total present values. But remember, part A is requiring us to get the net present value. You can see here, compute the base net present value. So we need to deduct the initial cash outlays. So initial cost, you're saying plus, should I say plus or should I say minus? So you say minus that value. The initial cost is there. So 40 million. Remember, the initial cost over here will change. This value here will change based on whatever you calculated over here. You can see it's 42 million. So we'll just change Control R, that, we get the NPV. Put it Control B, then you put a top and bottom border plus so then it may not be very clear, so I pick that thick border there, and then I put also this other border here with the permission. It's just presentation, good for presentation, characteristics of good financial models there. So with that then we have the scenarios. Part B, carry out a sensitivity analysis for NPV assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital there. So the base case we'll have, so part B, I can do it just down over here. So the base, we'll just almost like sort of copying this. Down over here. Then we have the NPVs down here, because we have the NPVs given to us over here, and net present values. NPV. NPVs. So just pick those ones. Then once you pick one, then you just drag it. With that, we can then just, now we've done that, carry out a sensitivity analysis, we've already done the sensitivity analysis, prepare an appropriate chart to indicate the different NPVs. So part A was to compute the base case NPV. We have already done that. The base case NPV is this. Then from there, we are told part B to carry out a sensitivity analysis of NPV, assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital. Adverse effect. So the initial cost, was given to us over here as 40 million. So we've done an adverse, the opposite, the adverse, by increasing it of, or rather, by increasing it by 5%. So we've increased it by 5%. Here we've reduced the unit sales by 5%. The selling price we've reduced by 5%. So we're trying to answer part B, carrying out a sensitivity analysis assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital. Yeah. So we cannot have an adverse effect for the initial cost. We cannot, unless the cost is an adverse effect, means that the initial cost increases in value. That's what we mean. It cannot reduce. If the initial cost reduces, it means it's an advantage to us because we are spending less. You get the point? So the unit sales is now when you're getting a negative value over here. The unit sales decrease. The selling price also decreases here. The variable cost, because it's a cost. The only way a cost can be an adverse effect is if it increases. That's what you're saying. A fixed cost is, because it's a cost, if it increases is when it becomes an adverse effect. For residual value, becomes an effect when the value actually decreases. And that's why we are putting these values differently there. I hope that point is driven home. So with that, then I'll just go to part C here. So we've done a sensitivity analysis for the adverse effects of initial cost, selling price, fixed cost, variable cost, and residual value. And then we are told to prepare an appropriate chart to indicate the different NPVs, each scenario in B above. So what we'll do, we just go towards the right here. Towards the right. And we come and we move on to insert. Once we go to insert, we can come to recommended charts. Click on recommended charts. And you can see whichever chart pleases you, you can be able to decide to, so long as it yields whatever we actually need. So this one, maybe perhaps select this value here, this one. And we say, okay. So the different NPVs that, or the different sets of, or the adverse effects of those values, base case, are actually indicated to us over here. And this means that at the base case, we are actually over there. The initial cost sensitivity plus 5%, because it's a cost. Any cost should be, an adverse effect should actually increase or get a positive value. But any positive value or selling price or what we are selling should actually be indicated by a negative sign if it is going to be an adverse effect. So these are the NPVs based on the initial cost, the annual sales, selling price, the variable cost, and the fixed cost, as well as the residual value. So this, ladies and gentlemen, brings us to the end of question 22, business and data analytics. We hope that you have enjoyed being with Manifested Publishers. Thank you and God bless you.
Welcome to Manifested Publishers. My names are Mr. Bernard Mariga. We can start with a question in August of 2022. Let's start with a question in August 2022. 2022, question 3B. August 2022, question 3B is a question I want us to deal with. Question 3B of August 2022. And this question states, a hotel with 50 single rooms is recording 80% occupancy in a normal season of 8 months and 50% occupancy in off-season of 4 months in a year. The following information is provided. You have annual fixed expenses, staff salaries excluding room attendants of 7.5, repairs and maintenance of 2.6 million, depreciation on buildings and furniture of 2.4 million, other fixed expenses like dusting and sweeping is 3.25 million. So that your total fixed cost is 15,750. Variable expenses per guest per day. Linen and laundry is 300. Electricity and other facilities 200. Miscellaneous expenses 250. Then the management wishes to realize a profit of 25% on total cost. 25% on total cost. Required. Number 1, the required tariff rate per room. Number 2, the break-even occupancy in normal season, assuming 50% occupancy in off-season. Number 3, the management is proposing a 20% decrease in tariff to improve occupancy at 100% and 70% in normal season and off-season, respectively. Advice on the appropriateness or otherwise of the above proposal. So let's analyze what we have been given in this question. One of the items you have been given is the fixed costs. And your fixed cost in total is how much? 15,750,000. 15,750,000. Then you also have another cost that is known as a variable cost. And a variable cost, remember, is a cost that increases with the output. It also decreases with output. A good example of a variable cost is direct material, direct labor, direct expenses. Variable overheads should also be added to those costs I have mentioned above to determine your variable costs. So your variable cost here, they have said there is a linen and laundry of 300 plus electricity and other facilities of 200 plus miscellaneous expenses of 200 and what? 50. Of 250. So that 300 plus 200 plus 250, 300 plus 200 plus 250 should be 700 and what? 50. 750. Then we can then answer, go back to what we require, what the question is asking. They want the required tariff rate per who? Per room. The required tariff rate per who? Per room. So the required tariff rate per room. So in this question, what they are simply asking you to do is to determine your selling price P. That is what they want you to determine. That is what they want you to determine, okay? Or your revenues, So we are going to take our annual fixed costs. We are going to take our revenues as your fixed costs plus your variable costs. Let me say fixed costs. Let me just write it in full. Fixed costs plus variable costs plus your profit. So your sales revenue is simply the cost. Remember, these are the costs, total costs, plus your profit, okay? We already have the fixed costs, which we have seen as 15,750. The variable cost here is 750, but it is per who? Per guest per day. So we need to determine our total variable costs. Our total variable costs. How do you do that? You determine your total variable cost by taking the variable cost per unit. You multiply that by your units. And in this case, you want to multiply that by the number of guests you have in an organization. In this organization. So let's determine the number of guests you have, where Q, in this case, is your number of who? Guests. Q is your number of who? Guests. Let's determine the number of guests. The first paragraph on us, they're saying a hotel with 50 single rooms is recording 80% occupancy in normal season of 8 months and 50% occupancy in off season of how many months? 4 months in a year. Then assume a 30-day month in all cases. So let's determine, we write there, determination of the number of guests. Or the occupancy. We are going to take that by taking during peak season. You had 80% occupancy. You multiply that by the 50 rooms that organization has. They are occupied for how many months? 8 months. 8 months. Then you multiply by the number of days. Number of days, that is during peak season. Plus, you also do the same for what? Off peak season. And how will you do that? You're going to take 50 50% occupancy. The rooms that are being occupied are 50 rooms. The off-peak season lasts for 4 months. But each month has how many days? 30 days. 30 days. So let's identify the occupancy level. Let's identify the occupancy level. During peak season, you expect 9,600 as the number of what? Guests that will occupy that. Then during off-peak, you expect 3,000 guests. So that in total, you're going to have how many guests? 12,600 guests. You're going to have 12,600 what? Guests. The reason we are determining the number of guests, remember, is so that we can be able to determine our total variable cost, which will be the product of a variable cost per unit that already we have of 750. Then by the number of units, which are your guests, which are how much? 12,600. So therefore, your total variable cost will be your variable cost per unit of 750. You multiply by 12,600. 750 times 12,600. So therefore, your total variable cost is 9.4 million. 9.45 million. Once we have determined our variable cost, we then will add our fixed cost to determine our total costs. Then our what? Profit. So let's come here and say that your total fixed costs, your total fixed cost is how much? 15,750,000 plus your variable cost will give you your total costs. And how much is your total cost in this case, class? $25,200,000. That is your total what? Costs. But remember, to get our revenue, we simply take our total cost plus our what? Profit. So then we need to add our profit. We need to add our profit. And they were saying that profit is 25% on what? Cost. So this is known as profit markup. So you're going to say 25% of 25, 200 what? 1,000. That will give you 6.3 million. 6.3 million. So to get our revenue, you then add, which is 31,500 what? 1,000. 31,500,000. You refer to that as your total revenue. As your total revenue. When we have our total revenue, we can now determine our what? Selling price per unit. We can determine our selling price per who? Per unit. So let me do away with this. You know that to get your revenue, you simply take your selling price per unit, you multiply by your units. Therefore, our revenue or our revenue can be used to determine your what? selling price per unit by simply taking your total revenue, you divide by what? Your units. Your total revenue is how much? 31,500,000 divide by 31,500,000 divide by your total number of what? Guests. In this case, we are dealing with a hotel, so we normally have got what? Guests. So therefore, divide by the total number of guests, which are 12,600. So please confirm that that is 2,500 per who? Per guests. 2,500 per who? Per guests. So each guest will be charged how much? 2,500. So that's the first part of that question. The required tariff rate per who? Per room, eh? All right. Then note number 2. Note, and that should be per room. Note number 2. The break, or rather, required note 2. The break-even occupancy in normal sales, assuming occupancy is 50% of season. Eh? So the break-even point. Break-even point. All right. So we can have this in what? In units, which in this case is in your what? Guests. Your guests are the measure of what the company is producing. Eh? To determine your break-even point in units, you simply take your fixed costs, divide by your contribution margin. Divide by your contribution margin. Your contribution margin, we've said, is the difference between your selling price and your variable cost per unit. Your selling price, we've just determined it as 2,500. Your variable cost per unit was 750. So therefore, to determine the contribution margin from the above, you will take 2,500 divided by minus 750 to get a contribution margin of 1,750. So your break-even point in units will be a fixed cost. Your fixed cost was 750,000. Divide by 1,750. Divide by 1,750. So for that organization to be able to cover its cost, they need to have to occupy 99 rooms or what? Guests. Right. In shillings, what sometimes they refer to as break-even point revenue. Revenue, shillings, or sales. If you see break-even point revenue or sales, it basically means break-even point in what? Shillings. It is determined by taking your fixed cost, divide by contribution margin sales ratio. Divide by contribution margin sales ratio. Your contribution margin sales ratio is given by contribution margin divided by selling price. Contribution margin divided by selling price. Your contribution margin is 1,750 with the selling price of 2,500. With the selling price of 2,500. So your contribution margin sales ratio is 0.7. So therefore, your break-even point will be 15,750,000 divide by 0.7. Divide by 0.7. So for that company to be able to break even, they need to sell 22,500,000. They need to sell 22,500,000, which could also be obtained by taking your break-even points in units, you multiply by your selling price. You multiply by your selling price. So these two answers should be the same. Those two answers, indeed, they are the same. So those two answers, indeed, they are what? The same. All right. Part 3 of that question. Part 3 of that question. They are saying the management is proposing a 20% decrease in tariff to improve occupancy at 100% and 70% in normal season and off-season respectively. Advice on the proposal above. So part 3. Decrease selling price by what? By 20%. Decrease the selling price by 20%. Now, to analyze this question, to analyze this particular question, there are two ways we can do that. Number one, we can determine the profits of that company after they have dropped the selling price by 20%. Number two, we can determine the contribution as a result of dropping the what? The selling price by 20%. Once we have done that, we then compare with our current what? Selling price. So when you're making decisions here, you normally make decisions considering by taking the contribution or the profit. The contribution or the what? Profit. So let me see. Let us do this together. Let's do this together. Your new selling price P, the decrease by 20%, it means your new selling price will be 80% of the current selling price, and the current selling price is what? 2,500. So that your new selling price. The variable cost is not changing. It is still going to be 750, which is 300 plus who? 200 plus 250 to give you how much? 750. So that now your contribution margin will be 2000 minus what? 750. It will be 1250. 1250. Your contribution margin sales ratio. Your contribution margin sales ratio is your contribution margin divided by what? Divide by P. 1250 divided by 0.625. That is your new what? Contribution margin sales ratio. To determine your profit, you know, you simply take your contribution margin, you multiply by your units minus your fixed costs. Alternatively, you can take your contribution margin sales ratio, you multiply by your revenue in shillings minus your who? Fixed cost, minus your revenue times your revenue minus your fixed cost. Let's determine the units as a result of what? The drop in what? Selling price. They're saying that if you decrease the selling price by 20%, you're going to improve occupancy at 100% and 70% in the normal what? Season. So we need to get our new the number of guests that are going to occupy that. So you're going to say it is 50 what? Rooms that are being occupied what percent? 100%. They are being occupied for how many months? 8 months during peak season. And you know each month is having how many days? 30 days plus there are 50 rooms that will be occupied 70% of the time. The occupancy during off-peak is how many months? 4 months. Then per day is how much? 30 days. 30 days. So this means that is 1200 guests. That is 4200 guests. Right, so that the total here will be 16,200 who? Guests. So when the company reduces the selling price by what? By 20%, your occupancy will increase or will come to what? 16,200. Let's get now the profit. Let's get the profit. You're going to say your profit here is your contribution margin. Your contribution margin was 1250. You multiply by how many guests? 16,200 minus a fixed cost of 15,750,000 or 15,750. So therefore, your profit should be 4,500,000. Now, then let's advise them. Remember, they are saying we advise them. We want to advise them on whether they should drop the selling price by 20% or they should continue selling and continue with the selling price of how much? 2,500. Now, when your selling price is how much? 2,500. Your profit is how much? Your profit in shillings, and your selling price is 2,500. Your profit is 6,300. 6.3 million. When you drop your selling price by 20% to how much? To 2,000. Your profit is how much? 4,500,000. 4.5 million. So there is a decline in profit by what? By 1,800 or 1.8 million. So therefore, what will you advise them? You're going to tell them to continue with selling price of how much? Of 2,500. Why is that so? Because the profits have dropped to 4,500 when you have done what? When you have dropped your selling price with an intention of increasing your occupancy. So kindly tell that organization not to drop its what? Selling price. Not to drop its selling price. All right. Now that we have understood a single product, CVP, in your own free time, you can look at April 2023, question 4C. Now, you can look at a similar question, the previous question. You can look at a previous question. It has been tested just a few semesters back. Let's go to September 2021. September 2021. September 2021. Question who? 5B. September 2021. Question 5B. The question is saying the standard cost of certain chemical mixture is 40% material A at 20 per kg, 60% material B at 30 per kg. The standard loss of 10% is expected during production. during the month of July, the actual data was as follows. Material A used 90 kgs at a cost of 18 per kg. Material B used 110 kgs at a cost of 34. The weight produced was 182 kgs of good production. Let's start by getting our material mix, our material price variance. Our material price variance, you say it is your actual quantity, standard price minus actual price, Your actual quantity, you have two types of materials, A and who? B. The actual quantity you purchased was 90 kgs. The standard price per kg was 20 minus an actual price of 18. For material B, your actual quantity was 110. Standard price per kg was 30 and your actual price per kg was 34. 30 minus 34. This must be 180. That must be 400 and what? 40. The standard or the material price variance here for A, you had budgeted to buy at 20, but instead of buying at 20, you bought at what? 18. So that's good. So that is what? Favorable. B, you had budgeted to buy at 30, ended up buying at 34. So that is also what? That is adverse because you've spent an extra amount. Then you confirm what kind of variance this is, and this is 250, which is what? Adverse. 260, which is adverse. That is your material price variance. Let's get our material mix variance. And how do you get your material mix variance? You say it is your standard price, your actual quantity in standard mix minus your actual quantity in actual mix. Standard price, actual quantity in standard mix minus actual quantity in actual mix. And actual is standard price B. The standard price of A is 20, B is 30. Your actual quantity that was used is 90 for A and 110 for B. Your standard mix, the ratio of how you are using your materials is 40 is to 60. That is 200. That is 100. Therefore, actual quantity in standard mix. You simply share the actual quantity using the ratio of your standard mix. Using the ratio of your standard mix. And how will that be? This will be 40 over 100 times 200. 60 over 100 times 200. That is 80, and that is what? 120. Alright, your actual quantity in actual means we said, in actual mix we said is your actual quantity. So let's get your material mix variance here. Your standard price is 20. Actual quantity in standard mix is 80. Minus an actual quantity of 90. 100. Standard price of 30. Actual quantity in standard mix of 120. Actual quantity in actual mix of 110. This will be adverse. favorable. So that in total that will be 100 favorable. Okay. The next item they are asking us to determine is your material yield what? Variance. Material yield variance. You said, how do you get that? You simply take your standard material cost per unit into bracket your standard yield minus your actual yield. Standard yield minus actual yield. Let's determine our standard material cost per unit. They were saying there that the standard cost of material of a certain chemical, 40% of material B was bought at 20, 60% of material B was bought at 30. So therefore, your material cost per unit, you're going to take those percentages times the price of each. Which will be 26. That should give you 26. Let's determine our standard yield. Then now need to determine our standard yield. Now they were saying the standard cost of a certain chemical mixture is 40 and 60, and a standard loss of how much? 10% is expected during what? Production. Okay. So this is what we do here. We first identify the input materials that were introduced and the output that was done what? Produced. Okay. And here with an 100% input of materials, with an 100% input of materials, your output was 90%. Your output was what? 90%. Why? Because of a standard loss of 10%. 10%. Okay. If you introduce 200, this can ignore this percentage here. That way. If you introduce 200, how much should have been your standard yield there? Your standard yield should have been 180 units. If you are to use the material in the same way you are using according to what you budgeted, you should have produced 180 units. So your yield variance will be 26, 180 minus an actual yield of 182. Your actual yield is 182. This is 52, which we are going to say is what? This is an output. This is output. So yield means output. So we are going to say it is what? Favorable. Favorable. Okay. Your material usage variance, it's going to be your material mix variance plus your material yield variance plus your material yield variance. Your mix variance is 100 favorable. Your yield variance is 52 favorable. So that is 162 what? Favorable. Let's determine our material cost variance, which is your material price plus your material usage variance. Your price variance is 260 adverse plus 162 what? Favorable. Which means that is 98 what? Adverse. 98 adverse. And that is how you determine your what? Your advanced variances of who? Of material. Those are the advanced variances of what? Material. All right. Now that we have understood the advanced variances of material, we also should look at the advanced variances of labor, the advanced variances of fixed overheads, and also the advanced variances of sales revenue. Okay, all right. I hope that has been clearly understood. That has been clearly understood. That has been clearly understood. Right. Now, when we meet in the next lesson, we will introduce the advanced variances of what? Labor. We will introduce the advanced variances of labor, which will be in the next lesson. So from me, you can attempt a question, to give you a question that you can attempt in your own free time. You can look at August 2022 question 5B as an assignment, just for your practice. Sorry, your assignment. Please look at this question for your own practice. August 2022 question 5B. Question 5B. There is a variance of what? It is an advanced variance of materials. All right. So allow me, and on behalf of the institution, or on behalf of Manifested Publishers, we can call it a day. See you next time when we will tackle labor variances and overhead variances and sales variances that are advanced in nature. So goodbye and God bless you. See you next time.
Hello learner, welcome to Manifested eLearning platform. My name is F.A. Emlingwiri, and today, ladies and gentlemen, we are discussing about the business and data analytics April 2023 question 22. It reads as follows: you work as a management accountant for Majani Limited, which deals in tea production and export. Before embarking on next year's budgeting, you are tasked with analyzing past revenue and price trends. As a starting point, your supervisor has provided you with historical price and production data as shown in the worksheet. So you can see the dates have been given to you, the production, millions of kilograms, prices per kilogram. We move down and see what we are required to do. A. Plot a line graph for price against time or dates. Insert a linear trend line displaying the equation and R squared on the chart. Briefly discuss your results. So we go back up here and pick the relevant data. We start with the dates, move down like so. Then we go back up again and pick the prices. But before we pick the prices, we need to press Control so that now it can jointly pick the dates and the prices at the same time. So you can see as I press Control. Then you hover around Insert, click on Insert. Then you come to Line Chart. This is what to say, the line chart. So you click on it. Then you proceed on to click whichever chart pleases you amongst this list of for line charts. So let me click on the first one. So as you click on the first one there, we just need to just be patient a bit so that now the output like so can actually come out. So what we do, we just place this where it's supposed to actually be, next to the solution, ladies and gentlemen, there. And moving like so would mean that we would be able just to place the data where it is actually supposed to be, which is right over here. So what are we told? we are told that we need then to plot the line graph. That's okay, we've done that. Insert a linear trend line displaying the equation and r squared. So we need to display the equation and r squared. R squared represents the coefficient of determination. Coefficient of determination assists the investment expert or the accountant to identify whether the regression is reliable. So we go back up here and we just right click on the graph. We add a trend line right here, and when we click on this like that, the trend line should be able to appear. As you can see, moving towards the right here, the trend line appears. We can then now display the equation. So you can see all of these inputs over here. There's either exponential, there's linear. Linear is what we've been told that we need to do. The trend name, we just say it is the linear price per kg, which is okay. Then we move ahead and say that we need to display the equation, which is there. We tick that. And then we also display the r squared over here. So we tick that. That's what we've been told by the examiner. And then we can close this part here, close it. And for a clearer picture, we can place the equation just above there like that. And then also what is going to appear is going to be the r squared. Now that's much clearer as compared to where it was initially placed right there. So this is our part A. We can then move ahead and try and identify what we've been asked for part B. For part B, we are told using a suitable MS Excel function, show that the coefficients shown in the trend line in A above are in fact a result of a linear estimation between historical prices and time. So what we do is that there is what is called a leanest function over here. So we move this over here like this. Say this is part A. Like that. So you can put over here part B. And we now use the leanest function plus leanest. So what is leanest? We are saying that the leanest represents linear estimation in full, and this value returns the statistic as it's shown over here. It returns the statistics that describe a linear trend matching known data points by fitting a straight line using least squares method. So what we do is that we then now need to identify what our y value is. Our y value represents the prices per kg. So come over here and highlight everything there for known y's. That. And then we go back up. Our known x's. Our x's are influenced, are the what we call the independent variables. They're the ones that influence the y's, saying that the dates and the production in kgs, we highlight both of them together like so. And then clicking on this part over here called constant here, it represents a logical value, and we say true over here. True. That. And we say okay. So we are told that an unexpected error occurred. So we just click OK here, because we are saying that we are getting negative 0.74. And this is the formula for the linear estimation. So linear estimation right here. And we say leanest. Like so. Leanest. We can be able to put it like so. And put it in form of maybe say perhaps maybe you can be able to just highlight maybe in a different color and maybe just for presentation purposes there. So you can put it like so. Then maybe you can proceed on to put it in form of a thick square outside there. So we expect that this 0.7412 should actually be the same as the value right over there from the equation. So moving on, we can then move on to part C. Part C, you can see that that prices are affected by production. Because of this, you would like to run a regression between price, production, and time. Use data analysis toolpack to run regression analysis, interpret your results. Be sure to discuss the coefficients and the parameters. So what we do is that we run a regression, part C here. Like so. And then we pick the dependent and the independent variable. So the data analysis toolpack is under the data tab here. Click on data. Then on the far right, you can see data analysis. Click on data analysis. And then you search for regression right here. You can see regression is right there. Click OK. What is our Y input range? The prices. So we click the prices like so. And then our X input, click there. We go back up again and we can see that both the dates, this is a multiple linear regression, the dates and the production levels are the ones that influence prices. That. So if perhaps you would want the labels, be able to put in labels over there like that, and then we click OK. So we have this output. So you can copy this output right over here and place it as appropriate on question 22 right under part C here. Control V. And we are saying that we can be able to see these regression statistics, R squared, which represents coefficient of determination. The standard error has also been given. We also have number of observations, or 154. That. And here is what we have as the intercept right here. We have the intercepts right over here. Then we have the dates over here. So you can change this to dates. And here you can be able to say production and millions per kgs production. Kgs. That. When x is 0, what is the value of y? Then that's what is represented by the intercept there. The dates are coefficients that influence the prices, the dates as well as the production in terms of kg. So we are saying that you can see this is the intercept and the date and the production per kg. That. Notice that under leanest over here, we expect negative 0.074. That. So 0.074 should be the part of the intercept right there. We can now move on and understand or analyze the p-values here. Come to home and we come like so, we do like so. We are saying that low p-values less than 0.05 means that the coefficient is likely not to equal 0. But if we have high p-values greater than 0.05, then we are saying that we cannot conclude that the explanatory variables actually affect the dependent variable. In terms of the F statistic over here, we need to look at the F statistic in collaboration with the P values. The F statistic, or rather, when you're saying that because the P values over here are greater than 0.05, with the exception of this production of kgs, then the model might not be reliable for analysis, or might not be used for analysis. When we look at the R squared, our R squared is given to us right over here. I can highlight that over there. And we're saying that we want our R squared. If R squared is greater than 0.95, then the regression should actually be reliable. In our case over here, it is not greater than 0.95, and hence the model is not reliable for analysis. It cannot be used to predict the future production levels. So what can we conclude from that analysis? We can conclude that the model is not good, because we are saying that the R squared is not greater than 0.95. Secondly, we are also saying that the P values right over here, because most of them are actually greater than, all of them are actually greater than 0.05, all of them 0.05, we are saying that we cannot conclude that the explanatory variables actually affect the dependent variable. We can also conclude that innovations can be, for example, to remove this constant value over here, to try and evaluate and estimate if the value is okay, or we can be able to use other metrics or other time series data to analyze or make inferences of this data that we're analyzing towards our left. So that is it for question 22. We hope that you have enjoyed it and you've understood how to run a regression. Thank you for being with Manifested Publishers. Be blessed.
Welcome to Manifested Publishers. We offer KASNEB study materials and video lectures.
Candidates, here I am again to continue revising the paper that was tested in May 2019, that is Advanced Financial Management. Having done question 1, 2, 3, and 4, in our today's lesson we are going to tackle question number 5. And this question 5 is in two parts, part A and part B. Part A is a question that tests a candidate's knowledge in capital budgeting decision. Part B is a question from the topic mergers and acquisitions. I will read question 5A first, then I'll answer it here on the board. And as we answer these questions, candidates, I need to remind you that the objective of the Advanced Financial Management paper is to enable you that at the end of these sessions, you should be able to apply advanced financial management techniques in business. That is why you can see some of these questions are practical questions. These are problems that businesses face which call for techniques in advanced financial management. And as an accountant who is training, it should not also be lost on you that the purpose of studying advanced financial management is more than just passing the paper. As you study this paper, make sure you are gaining the skills, the knowledge, and the expertise that is required of you to solve problems that organizations face. Now, question 5A is a problem that requires the knowledge in capital budgeting, techniques in capital budgeting. So let me read the question. It says that Jeza Tours and Travel is a private limited company in the tourism industry. In order to improve customer service and provide the management with timely and quality information, the company is contemplating to purchase 8 microcomputers at a cost of 100,000 shillings each. Installation costs for all the computers will amount to 80,000 shillings. It is estimated that once installed, the computers will increase the company's earnings before depreciation and tax from 12 million shillings to 12,500,000 shillings annually. The computers are expected to last for 10 years, after which they will be obsolete with no resale value. The operations manager proposes that the computers will be useful for 15 years with no resale value. The marketing manager, on the other hand, argues that the company needs the computers for only 5 years, after which they can be disposed of at 50,000 shillings each. The probability distribution of the useful life of the computers is given as follows. The probability that the computers will be useful for 5 years is 0.2. Probability the computers will be useful for 10 years is 0.5. Probability that the computers will be useful in 15 years is 0.3. The company is in the 30% tax bracket. The company's cost of capital is 24% and uses the straight line method of depreciation. Required, Roman 1, the expected net present value of the project, 4 marks. Roman 2, the standard deviation of the expected net present value, 3 marks. Roman 3, if the net present value of the project is less than 200,000 shillings, the firm will be exposed to financial distress. Determine the probability that the firm will avoid financial distress. Assume normal distribution, 3 marks. Candidates, here is a problem, okay, that we need to solve. This is a past paper question that was tested in May 2019. The candidates who appeared in that exam were expected to answer this question so as to earn how many marks? These are 10 marks. 10 marks. So candidates, this again I repeat is a problem, and just like any other problem, this problem requires a formula. Every problem has a formula which has to be applied in solving it. So this is a problem that we need to solve, and the past paper question, this is May 2019. This is advanced financial management, question number 5, all right, May 2019, the advanced financial management paper. Part A, we are required to calculate the expected net present value. Okay, we are required to calculate the expected net present value. Expected net present value. Expected. We've been given the cash flows, all right, because we know for you to calculate the NPV of a project, then it's the difference between the NPV or the present value of cash inflows minus the present value of cash outflows. That is the general formula for calculation of NPV. So this is question 5A, Roman 1, expected NPV. Here is the formula. Expected NPV is equal to the NPV of the first alternative. And the first alternative is where the economic life of the computers is 5 years. So the NPV of the first alternative 5 years times probability of the 5 years, okay, probability of alternative where the machine is, the machines will last in the business for 5 years, plus NPV of the second alternative. And the second alternative is where the machines have an economic life of 10 years times probability of the machine lasting in the business for 10 years, that is 10, plus NPV of the third option, where the economic life of the computers is expected to be 15 years times probability that the computers will last in the business for 15 years. So this will be the expected NPV formula. So candidates, when in an exam, you need to be writing down the formula first, because it's on the basis of this formula that you are going to answer this question. Because even if you are not to answer the whole question, this one can earn you a mark. This part A, you can see there are 4 marks, right? Writing a formula can earn you 4 marks. So, can earn you a mark. So, candidates, we need to calculate the NPV, where the economic life of the computers is 5 years. Then we multiply by probability as shown in the table there. It shows the probability distribution of the useful life of computers is given as follows. Useful life of 5 years, the probability is 0.2, and the other one 0.5, then 0.3. So we'll get the NPV where the economic life is 5 years times that probability. Then we add to the probability, we add to the NPV where the economic life is 10 years and probability for that option. Then we'll add the NPV where the economic useful life is 15 years times the probability of that alternative. So that is what we are going to do. Now, NPV for the first alternative. How do you calculate NPV for the first alternative? NPV for the first alternative will be the difference between the cash inflows minus cash outflows. So we are going to calculate the cash inflows minus the cash outflows. And from this question, we can read that it is estimated that once installed, the computers will increase the company's earnings before depreciation and tax from 12 million to 12.5 million annually. So these cash flows, because it's annually, that will tell you that these are annuities. It's very important. These are annuities. So these are incremental annuities. These are inflows. So we are going to deduct these inflows for every alternative by, we are going to subtract with the initial cash outlay. The initial cash outlay for every, the initial cash outlay is standard. You can see here that we are told in the second sentence that in order to improve customer service and provide the management with timely and quality information, the company is contemplating to purchase 8 microcomputers at a cost of 100,000 shillings each. So this will comprise part of the initial cost. Then down there we have installation cost for all the computers will amount to 80,000 shillings. So the initial cost plus installation cost, that will be the total initial cash outlay. So let's first work out the initial cash outlay. I'm going to have my workings here. These are my workings. Show all workings. Working number 1 will be the total initial cash outlay, and this will be equal to the cost. The cost that will be equal to the cost, that is the purchase cost, which is 1,000 shillings times 8 microcomputers. So this will be equal to the cost of computers plus installation cost. The cost of the 8 computers will be 8 computers times 100,000 shillings plus the installation of the 8 computers we were told in the question is 80,000. So we have 800,000 plus 80,000, which is equal to 880,000. That is the initial cash outlay that we'll use when computing the NPV for each option. That is working number 1. Now working number 1. Now working number 2, we need to calculate the NPV for each alternative. NPV for each alternative. There are 3 alternatives. That is 1, where the economic life of the computers is expected to be 5 years. The second alternative is where the economic life of the computers is expected to be 10 years. Then 3, where the economic life of the computers is expected to be 15 years. So the NPV where the economic life of the computers is 5 years, what is the NPV? The NPV will be equal to the cash inflows, will be equal to the present value of cash inflows minus the present value of cash outflows. That is the formula for NPV. So formula for NPV. We have seen the cash outflow, the initial cash outlay, which is 880,000. So what is the present value of the cash inflows? And we have said that this cash inflow, remember I said, is an annuity. These are annuities. So we are going to calculate the annuities, the annual cash inflow, annual cash inflows. Then we multiply with the present value annuity factor at 5 years, and the discounting rate will be the last sentence there, the company's cost of capital is 24% and uses the straight line method of depreciation. So candidates, these inflows, as we have read from the question, these are annuities. For us to compute the NPV for each alternative, then we need to have the annuities, the annual cash flows for each alternative. And let me have a formula let me have a working for the annual incremental net cash inflows. I'm going to have a working, okay, a working for for the net cash inflows. Net cash inflows. We need the net cash inflows for each option. So the net cash inflows will be equal to, this will be equal to, this is, let me just write in full for your revision, annual, let me call it annual incremental net operating cash inflows. This will be equal to this is net, let me abbreviate it, net operating cash inflows. This is equal to, this is an abbreviation of that, incremental net operating cash inflows will be equal to the earnings before depreciation and tax, earnings before depreciation and tax times 1 minus T plus DTS, depreciation tax shield, DTS, depreciation tax shield. So we want to compute the annual incremental net operating cash flows for the three options. The first option, the last option, I want to start with the last one here, is when the economic life is equal to 15 years, when the economic life N is equal to 10 years, and when the economic life N is equal to 5 years. So I want to have a working, just one working for these three options. So what is the EBT, earnings before depreciation and tax? It's an annuity, and that is in note number, the second paragraph. It says that it is estimated that once installed, the computers will increase the company's earnings before depreciation and tax from 12 million to 12.5 million annually. That's an annuity. Earnings before depreciation and tax. This is the incremental. We are working with incremental. Incremental earnings before depreciation and tax will be the difference between 12.5 million and 12 million, which is 500,000. 500,000. That is earnings before depreciation and tax. Then we deduct the tax. This is tax of 30%. So 30% times 500, this is equal to 150, 150, 150, 150, 150, 150, 150, giving us here 350, 350, 350. So these are earnings after tax. Okay, earnings after tax. We have deducted the tax. This is earnings after tax, or we can say this is EBDT 1 minus T. Okay, 1 minus T. 1 minus T. We've multiplied this by that tax, so this is minus the tax. This minus the tax. This minus the tax. Then we are going to add the depreciation tax shield. You see here we have EBDT 1 minus T, EBDT 1 minus T plus depreciation tax shield. We are going to calculate depreciation tax shield for each option. Depreciation tax shield for each option. Depreciation. Now let's go check the information for depreciation. Now it says the computers are expected to last for 10 years, after which they will be obsolete with no resale value. Then the operations manager proposes that the computers will be useful for 15 years with no resale value. The marketing manager, on the other hand, argues that the company needs the computers for only 5 years, after which they can be disposed of at 50,000 shillings each. 50,000 shillings each. Then the depreciation policy, the last sentence, the company's cost of capital is 24% and uses the straight line method of depreciation. So the depreciation tax shield candidates will be equal to the depreciation per annum times the tax rate, So we are going to have depreciation here will be the DTS. The DTS will be equal to 30%. That is depreciation. That is the tax times depreciation. And since this company is using the straight line method, that will be equal to the cost minus the scrap value or salvage value divided by the economic life. This is the formula for the DTS. The DTS will add to the after-tax earnings. Depreciation tax shield for the first option. The DTS for the first option, let me do it here. The DTS for the first option, where the economic life is 5 years, will be equal to 30% times the annual depreciation. The cost remains 880 minus the salvage value. We read that the salvage value will be 50, after which they can be disposed of at 50,000 shillings each. 50,000 shillings each. Each computer will be disposed of at 50,000 shillings each, meaning the salvage value of the 8 computers will be 50,000 times 8. 50,000 times 8, then we divide by 5 years. So this will give us the DTS, which is equal to this is 880 minus this is 400 minus 400 divided by 5 times 30%. I'm getting 28.8. For the depreciation tax shield, 28.8, that is for the first option. The second option, the DTS, where the economic life is expected to be 10 years, equal to 30% times 880,000 minus 0. We read the economic life is 0, then divide by 10 years. 10 years. So I'll have 880 divided by 10 times 30%, getting a 26.4. 26.4. Then lastly, DTS, where the economic life is 15 years, is equal to 30% times 880 minus 880,000 minus 0. The salvage value under this option is 0, divided by 15. So I'll take 880 divide 15 times 30%. This is equal to 17.6. 17.6. So after that, what am I going to do? I'm going to add this cash. This depreciation tax shield, I'm going to add it to the earnings after tax to get what we call the net cash flows, annual net cash flows. This will give us the annual net cash flows. Annual net cash flows is equal to EBDT times 1 minus T plus DTS. So let us add. I have 17.6 on my machine, so I just add the 350 to get 367.6. Then I add 350 to 26.4, 376. This is cannot be the same. This is 350 plus 26.4 plus 26.4, 370. I'm getting here 376.4. 376.4. Then I add 350 to 28.8. 350 plus 28.8 is equal to 378. 378.8. These are annual net cash flows. Annual net cash flows, meaning these are annuities. These are the expected cash inflows at the end of every year. And why are we calculating these annual net cash flows? So that we can calculate the NPVs for each alternative. NPV for each alternative. So that is important working there. So I'll come here and have other workings. I can have more workings. Okay. So candidates, you are going to begin with the calculation of the NPV of the alternative where the computers are expected to last for 5 years. 5 years. And I've just said these annual net cash flows are annuities. Annuities, annual net cash flows. These are cash flows. Here we have cash flows, cash inflows minus cash outflows. The cash outflows we had calculated will be 880,000 for the 3 alternatives. But for the cash inflows, they will vary, and you can see we have the annual net cash flows which are different. Another point to note before we calculate the NPVs is that we need to check if there are any other cash inflows. And these cash inflows, as usual, will always comprise, in most cases, the terminal cash flows. Terminal cash flows comprise the salvage value. If any machine will be disposed of at the end of the economic life, then that is a cash inflow. That also would include the net working capital to be recouped. In this question, we do not have the working capital elements, but we have the salvage value for the first alternative. Salvage value, remember here, was 50,000 shillings was to be raised at the end of the 5th year per computer. And that, if I can read from note number about the marketing manager down there, on the other hand, The marketing manager argues that the company needs the computers for only 5 years, after which they can be disposed of at 50,000 shillings each. That means that the total salvage value, which will be equal to the total cash flows, terminal cash flows, will be equal to 50,000 shillings times 8 computers, which will be equal to 400,000, which we calculated here. So for the first alternative, the NPV for the first alternative, where the economic life is 5 years, the present value cash inflows will comprise this annuity of 378,800 plus the salvage value. So the NPV will be equal to the NPV for the first alternative. This 5 should tell you that is the first alternative. That is equal to the annuity, this annuity 378.8 times the present value annuity factor. The discounting rate we saw from the question is 24% at 5 years. This is the present value of the annuity, and we will read this from the tables. Then we will add the present value interest factor at 24%, 5 years, times the salvage value of 400,000. Then this sum, this will comprise the present value of the cash inflows. Then we deduct the cash outflow, which is 880,000. This is the initial. That will be the initial cash outlay. So we can insert the inputs. We have the annuity here, that is 378.8. 378.8 times the factor, which can be read from the tables. From the table, the annuity, present value of an annuity, 24% 5 years, 24% 5 years, 24% 5 years. The factor is 2.7, 454 plus the present value 24%, present value interest factor 24% 5 years. So I have 3411, 0.3411 times 400,000. All right, this we are going to subtract 880,000. So I look for my machine and get the answer. So here I'll have 378.8 times 2.7454 plus 0.3411 times 400 minus 880. So the NPV here is equal to 29. Let me put the units. These are shillings. 29 shillings. 296,398 shillings. That is NPV for the first option. The second option, NPV, where the economic life is 10 years, will be equal to the annuity times present value annuity factor 24%, how many years? These are 10 years. 10 years minus 880,000. The annuity is 376.4. 376.4 times the annuity rate from the table. This is an annuity, 10 years, 24. 10 years, 24, this is 3.6819. 6819 minus 880. So let me do the calculation. 376.4 times 3.6819 minus 880. This is equal to 505,867. Next is the NPV. NPV for the economic life of 15 years, you have the annuity times PVAF 24%, 15 years. 15 years. 15 years minus 880,000. This is equal to the annuity 367.6 times the annuity 24%, 15 years. 24%, 15 years. This is 4.0013 minus 880. 880. What is the NPV? The NPV will 367.6 times 4.0013 minus 880. Minus 880. This is equal to shillings 590,878. So these are NPVs. The NPVs for each alternative. Alternative 1 is where the economic life is 5 years. Alternative 2, the economic life is 10 years. Alternative 3 is 15 years. And why are we calculating these NPVs? Is so that we can answer the question which required us to calculate the expected NPV. The question is, let me read it. The question is, let me go back to the question. Expected net present value of the project. Expected net present value of the project. How do you calculate that? We had the formula. NPV of the first alternative, which we have, so we can insert the inputs. We have 296,398 times the probability. From the question, we have the probability of 0.2. Was it 0.2? Yes, 0.2. 0.2 plus, this plus probability is 0.3, the NPV, second alternative, 505,867 times 0.5, is it? Yes, 0.5, plus the probability where the economic life of the machines will be 15 years. The NPV is 590,878 times probability of 0.3. So this will be the sum of the three will give us the expected NPV. 296, 398, 398 times 0.2 plus 505, 867 times 0.5 plus 590, 878 times 0.3. So the expected NPV is shillings 489,000 477. That is the answer, and that would earn you how many marks? 4 marks. 4 marks. All right, those are workings, which would help you earn how many marks? 4. All those workings are to help you earn how many marks? 4 marks. So that is part 1. Required Roman 2, the standard deviation of the expected NPV, the standard deviation of the expected NPV. 2, this is the standard deviation. Let me write it properly. Number 2 is the standard deviation of the expected NPV. I'll summarize it as standard deviation of expected NPV. Standard deviation of expected NPV. Now, the formula for the standard deviation of expected NPV will be equal to the square root of the summation of the values. N is equal to 1, NPV, these are deviations. Okay, we get the deviations, NPV minus expected NPV. We will square the deviations, then multiply by the probabilities. So we are simply going to get the deviations, because we have the NPVs for each alternative. These are the NPVs for each alternative, and we have the expected NPV. We have it. We get the deviations, square the deviations, and then multiply by the probabilities. So candidates, I'll start with have a column for probabilities. We have the probabilities. This is 0.2 for the first option, 0.2, the third option, 0.5, the second option, the third option, 0.3. Then I'll have another column for NPV. You have NPVs for each option. We subtract with the expected NPV, which you have calculated here. Expected NPV, we will then square the deviation. This will give you the deviation. Okay, the deviation from the expected NPV. Then we will multiply with the PI. Then we'll get the summation. Going to do the summation here. So let me be economical. Let me be what? Economical. We are calculating the standard deviation. So let's start with the first option where the NPV is 296, 398, 296, 398 minus the expected of 489, 477. So I have the deviation, which is a negative. Then I square it, then multiply by probability 0.2 times 0.2. So I'm getting here 7, 4, 5, 5, 4, 5, 5, 9, 0, 0, 0, 48, 0, 48. The second option, 505 is NPV 867 minus expected 48, 9, 477. That is the deviation. I square the deviation, then multiply by 0.5. The answer here is 134, 316, 134, 316, 050, 050. Then lastly, the NPV for the last option, 590. 590, 878 minus expected NPV 489, 477. I'll square the deviation, then multiply by probability of 0.3 to get 3, 0, 84, 64, 8, 840. Then I'll get the summation. I'll add these three. So when I add, this is equal to, that is 74559000048 plus 134316050 plus 3084648840. So I have the total there. Then let me do the standard deviation. The square root. The square root of this total is let me just do the square root of this total is equal to, so the answer, candidates, the square root is the standard deviation is 103,319 .238. That is the standard deviation of the expected net present value. And that we've answered part 2. Now, part 3 says, let's answer part 3. It says if the net present value of the project is less than 200,000 shillings, the firm will be exposed to a financial distress. Determine the probability that the firm will avoid financial distress. Assume normal distribution. 3 marks. Determine the probability. Let me rub here. Determine the probability the probability that the farm will avoid financial distress. Probability that the farm will avoid financial distress. And if the net present value of the is less than 200,000, the farm will be exposed to a financial distress. If the net present value of the project is less than 200,000 shillings, 200,000 shillings. Determine the probability that the farm will avoid financial distress. This is part 3. Part 3, probability that the farm will do what? The farm will avoid financial distress. So learners, for us to calculate the probability, first we are going to calculate the Z score or the Z value, and we know that the Z value or the Z score is equal to X, which represents the actual value. In our case, that will be the 200,000 shillings minus the mean mu divided by standard deviation. In our case, this is the general formula for calculating the Z score. In our case, the X will be the NPV of 200. That is at the point where the farm is likely to avoid distress. We've read that if the net present value of the project is less than 200,000 shillings, that will be the value for X or the NPV. Then the mean is the expected, that will represent the expected NPV. Expected NPV, that is expected NPV divided by the standard deviation of the expected NPV, the standard deviation of the expected NPV, which we have calculated here. We have the mean or the expected NPV, and we have the 200,000 shillings minus the mean of 48,947 divided by the standard deviation 103,319. This will be the Z score. So let me take my machine, and I can see there that is a negative. That is negative. It's a negative of 200,000 minus 48,947 divide 100. This is 103,319. This is equal to 2.8017. If I was to round it to 2 decimal places, this would be equal to 2.80. This is to 2 decimal places. So this Z value, we will now, candidates, read from the standard normal curve, the 2.80 as read from the normal curve. The value here is 0.4974. Now, candidates, if you are to draw the curve, let me just draw the curve to explain how we will arrive at the probability that the farm will avoid financial distress. If you are to do a normal curve, this is what we will have. This is what we are going to have. Our mean value, NPV here is at this point, and the amount, the value there is 489,474. We all know this region represents probability of 0.5%. This region is 0.5%. 5%. So what is the probability that the farm will avoid financial risk? Okay, if the financial distress, this is financial distress. If financial distress, we learn from the question, we read from the question that if the net present value of the project is less than 200,000 shillings, if the NPV is 489, that is the expected NPV, this is the mean, we say this is the mean. If the mean NPV is at this point, and we read that what is the probability that the farm will avoid financial distress if the NPV is 200? Because if the mean NPV is 489, then the 200 will be this side, on the left-hand side, because we're counting, assuming this is a number line, this will be 200,000 will be at that point. 200,000 will be at this point. We know that this is a probability of 0.5. So we need to calculate the probability that the farm will not get into financial distress, and that has to be this region, okay? This region, because this region if the region below 200,000, this is the region of financial distress. But you want to calculate the probability that the farm will not be exposed to financial distress. Financial distress. The farm can only be exposed to financial distress if the NPV is less than 200,000 shillings, and this is this region. Any amount of NPV beyond this region is safe. The farm will not be exposed to financial distress. Therefore, the probability of avoiding financial distress will be equal to the 0.5 plus 0.49 0.4974, 0.4974, which is equal to 0.5 plus 0.4974. This is equal to 0.9974. That is the probability of avoiding financial distress. In percentage, this will be 99.74% probability of avoiding financial distress. So that is how such question should be answered. And candidates, I'm done with the first part of question 5 of the May 2019 sitting. We are going to take a short break. When we come back, we'll answer question 5B. Go through the question once more, and again, there were similar questions that have been set in relation to this advanced capital budgeting question. Thank you, and hope to see you in our next session, where we'll complete this sitting by doing part B of question 5, May 2019 19. Bye-bye.
Welcome to Manifested Publishers. We proceed on economics paper. That is April 2024. The last question, question 1. Explain the term producer equilibrium as used in economics. Explain the term. That is 7 Roman A Roman 1. Explain the term producer equilibrium as used in economics. I just want to draw a diagram before I explain that. Basically explain that producer equilibrium. We can have this. This is an isocost. That is basically an isocost. So we have capital, and we have labor, and we have labor. This is an isocost. So AB is an isocost line. Then we draw an isoquant, not in difference curve, but isoquant. And then we have Q. We can say Q is 3. So the point that isoquant line forms a tangent with an isoquant, that is where we get the producer equilibrium. So we have equilibrium quantity of capital, that is KE, and equilibrium quantity of labor, that is LE. So we can say that this is 3,000. So we basically need to understand that 3,000 in this particular, 3,000 units is the level of output, is the level of output, is basically the level of output, is the level of output that basically gives the farm the maximum. We call it the maximum profit. Gives the farm basically the maximum profit. So what is producer's equilibrium? Refers to the level of output. Basically, we say producer equilibrium is therefore the farm, we say the farms, is therefore the farm's level of output, is the farm's level of output, Producer equilibrium is therefore the farm's level of output, which gives the maximum, what we call the maximum profit, which gives the maximum profit. And as you can see from the diagram, this is an isocost. AB is an isocost line, and then we have Q as an isoquant. So 3,000 is the level of output that will give the maximum profit. So a farm is said to be, just a continuation, a farm is said to be at producer equilibrium, A farm is basically said to be at producer equilibrium, if there is no scope, if scope is intention, if there is no scope of increasing, we say scope of increasing, the scope of increasing the profit, or reducing the scope of increasing profit or reducing the loss, the scope of increasing the profit or reducing the loss, by changing the output, by changing the quantity of output, by changing the quantity of output. By changing the quantity of the output. So if you look at that question, that's question particularly tackling 2 marks, but it's expounded fully. That is the diagram. So at 3,000, that is where we have producer equilibrium. So 3,000 units is the level of output that gives the maximum profit. But you say producer equilibrium is therefore the farm's level of output which gives the maximum profit, that basically gives the maximum profit. And you say that when a farm is basically at a producer equilibrium, the farm has no scope of either increasing profit or reducing the loss by changing the quantity of output, by changing the quantity of the output. That is how we particularly go through that question. We pick it on the next question, that is question 7, A Roman B. So the question says, highlight assumptions of the producer surplus. Highlight assumption, that is Roman 2. Highlight the assumptions, what do you call the assumptions of a producer surplus. Highlight the assumptions of a producer surplus. So before we highlight assumptions of a producer surplus, it is very important to understand what we basically mean by a producer surplus. When you talk about a producer surplus, we basically say that there is a difference between the amount the producer is willing to supply good for and the amount that they actually receive when they make the trade, which in most cases we say is an additional benefit, because you realize that what they receive is more than the minimum that they're willing to supply the goods for. So that is actually a benefit. So if you're to draw, that is not of essence, but you can particularly have questions that will tell you to define a producer surplus and draw the diagram. But for this particular question, it has simply asked on highlight 5 assumptions of the producer surplus. When you look at those assumptions, one, we talk about producer is assumed to be rational. Basically, a consumer is aiming to maximize profit, and we know that we maximize profit where MR is equals to MC. So we say number 1, producer. When we say producer is assumed to be rational, i.e. we say aim to maximize the profit, We know i.e. at the point, MR is equals to MC. That is basically where the consumer basically aims to maximize the profit. The second assumption is that there is perfect competition. There's a perfect competition market. Number 2, we say there is a perfect competitive. There is a perfect competitive. We call it a perfect competitive. There is a perfect competitive perfect competition market. There is a perfect competition market. We know how a perfect competition basically work, and we say that assumed to be perfect, perfectly competitive. Assumed to be perfectly. We say perfectly competitive. Consumer is basically assumed to be perfectly competitive. Then you say that there is free entry and exit. There is a next assumption. There is what you call free entry and exit, i.e. there is free entry and exit, i.e. that is to say that producer can freely enter and exit. Can freely enter and exit as the third assumption. The fourth assumption, basically, we say there is no externalities. There is no externalities. There is no externalities as the next assumption. Basically, we say that there is no externality. that is saying external cost and benefits, external cost or benefit. No external, what you call external costs and benefits, and benefit. No external cost and benefits. And lastly, assumptions, we say constant return to scale. The fifth assumption, we say constant return. We call it constant return to scale. What do you basically mean by constant return to scale? We know that average cost of production remains constant. Average, that is to say average cost of the production, average cost of the production, average cost of the production remains constant, remains constant, remains constant. Average cost of production basically remains constant as quantity produces increases, as quantity produces, as quantity produces increases, as quantity produces basically increases, as quantity produces basically increases, as the quantity produced basically increases. Again, I said at the beginning of that particular question, I said you can be asked what a producer supply as a major area, and you can also be told to illustrate using a diagram how producer supplies basically come. And that is how we particularly handle that question. That is question 7A Roman 2. That is how we go about that question. We pick it on the next question, that is question 7 Roman B. With the help of a well-labeled diagram, explain the stages of law of diminishing return. We put that question down. With a 8, we say with a 8, with a 8, we call it with a 8, with the aid of a diagram, with the aid of a diagram, we say explain the stages, explain the stages of the law of diminishing, of the law of diminishing return, of the law of diminishing return. So when you talk about the law of diminishing return, we also call it the law of variable proportion. What does the law of variable proportion basically talks about? We say that when a variable factor of production, that is labor, is added to fixed factor of production, and that is land, we say that total output increases, but at a decreasing rate. The total output increases, but at a decreasing rate. We can illustrate, first of all, come up with the diagram. We proceed to this at the end because this end is a bit small. So we have our diagram on this end. And you talk about those stages. Basically, this law of diminishing return or the law of variable proportion, we have it here. So this is what we call total product at that end. We have the total product. We have this as average product. We have it as average product. Then up here, we have what we call the marginal product. So on this other end, we have total product, marginal product, and average product. And down there, we have quantity. We have the quantity. We illustrate on that point. At that point, we illustrate. So we have what we call stage 1 on this day, stage 1. We have stage 2. And finally, we have stage 3 on this other end. We have stage 1, this is stage 2, and this is stage 3. So basically, when you talk about the law of variable proportion, the diagram is this, and the diagram is basically divided into 3. So we have the first stage, we call it increasing, what we call increasing returns. Increasing returns. So on basically increasing return, we are saying that when a variable factor is added, and the variable factor is labor, is added to a fixed factor of production, which is land, total product increase but at a decreasing rate. So what essentially happens in this part is that when that happens, when we talk about TP, we talk about MR. MR and you talk about AR, are all increasing, are all increasing. All of them are increasing. All of them are basically increasing. That is at increasing return, which is stage one. Stage one. Stage one, as it is. That is stage one. That is what happens in the stage one. That TP, MR, and AR are all increasing when a variable factor is added to a fixed factor of production, which is land. We have the TP, we have the MR, and AR all increasing. Stage two, we call it a constant return. So basically we are saying that when we basically had a variable factor, which in this case is labor, to a fixed factor of production, which is land, we will see that at this particular stage, in as much as probably you can have the total product increasing, we'll see the margin of product. At this point, we'll find the margin of product. If you look at the margin of product remaining constant. Margin of product will have the margin of product basically remaining marginal product at a particular point, margin of product remaining constant. So you'll have a margin of product at one point. Maybe you have between quantities, quantity. You can have maybe a quantity that follows, maybe between 4 and 5. You're having a marginal product, which is MP. This is P. Sorry, average product, and that. This is average product. Sorry for that. This is marginal product. So we have the total product in the first stage, marginal product, and AP all increasing. The second stage, we are saying that it's called a constant return. What you call a constant return. So on the constant return, we'll have the TP increasing, but you find at that particular stage, MR remain constant at a particular stage. Maybe a unit of 4 to 5, you find MP. Sorry, that is the MP, which is the marginal product remaining constant. So we can have the total product increasing, but you'll find MP remain constant, maybe at 4 and 5. So that is what you call constant return. And then we have the third stage. The third stage, we have what you call decreasing stage. So on the decreasing stage, look at the decreasing stage, which is stage 3. This was stage 2. This was stage 2. This is stage 3. This is basically stage 3. So decreasing stage, we can see the total product, we can see the average product, and we can see the marginal product are all decreasing. In fact, the marginal product is negative. So we see TP, AP, and MP are decreasing. So when we add a variable factor, which is labor, to a fixed factor of production, which is land, total product, average product, and marginal product are all decreasing. But we can see also that at that particular point, MP is even getting MP gets negative. Initiating inefficient MP is negative even at that stage. So for the diagram, that question is 6 marks. The diagram will constitute a huge number of marks. If it's 6 marks, the diagram will particularly take a huge mark. The diagram could take even 3 or 4 marks. Then the explanations that we have summarized on this particular point, those will take the remaining marks, which is either 2 or 1, maybe there. But the diagram will basically constitute a lot of the marks in that particular question. The diagram will constitute a lot of marks in that particular question. And that is how we particularly go about that very question. But even on this, we have assumptions of the law of variable proportion, or the law of diminishing returns. The law of variable proportion, or the law of diminishing return. You can have the assumptions. You can be asked the assumption. You can also be asked. On shortcomings or limitations of the law of diminishing return. That is how we particularly handle that specific question. We proceed from the next question. That is question 7, Roman C. Explain 4 monetary policies that the central bank of a country might apply to control inflation. That the central bank of any country might apply to control inflation. So when you look at this particular question on a yearly basis, this is a question that keeps on repeating itself. Even on the 2020, even on the other exams, you find particularly questions that touches on monetary policy is always there. So we put down the question, then we go through the question. So that is to say, explain, one we call explain, 7 Roman C, explain, 4, say 4 monetary policies, that a central bank of a country, might apply to control inflation. So I explained 4 monetary policies that a central bank of a country might apply to control inflation. Number 1 is to understand what you call monetary policy. Whenever we talk about monetary policy, we basically call it, these are instruments that are basically used by the government through the central bank to regulate the supply of money. Either the supply of money is high or low. How do you use these instruments to basically control inflation? The first one we talk about is what you call the bank rate. Where the first one you call it the bank rate stroke what you call the interest rate. The bank rate stroke what you call the interest rate. So when you talk about the bank rate stroke the interest rate, we know that when the supply of money is high, the interest rate is usually raised to reduce the money supply altogether, or to reduce inflation, and vice versa. So we say that during inflation stroke high supply of money, interest rates are raised. Hence this will control inflation. Hence this will control inflation. Stroke reduces the supply, high supply of money. So the second one, we can talk about what you call open market operation. Market operation. So when you talk about open market operation, this is buying, what you call buying and selling of the government security. Buying and selling of the government security. And particularly when you talk about the buying and selling of the government security, we're talking about T-bonds and treasury bills and bonds. So we basically know that when there's a high supply of money, that is when there's inflation, the government will basically sell security to the public to reduce the flow of money. So we said during inflation, the government, we say that the government will sell securities to the public to the public in order to reduce inflation, stroke high circulation of money. High circulation of money. So we have number 3, what we call compulsory deposit. Stroke reserve requirement. What we call reserve requirement. Compulsory deposit stroke what we call the reserve requirement. Whenever we talk about the reserve requirement stroke the compulsory deposit, we basically mean that all the commercial banks must hold a reserve with the central bank of any country. And we're basically saying that when there is inflation or when there is high circulation of money in the economy, what the banks or the government in relation to the central bank basically do is that they increase the compulsory ratio or the reserve requirement to make sure that most of the money are with the CBK. So we need to say that during inflation, the government through the CBK or the central bank of any country will increase the reserve stroke what you call the compulsory ratio, compulsory deposit, not ratio but compulsory deposit to ensure there is no high circulation. There's no high circulation of money to the public. There's no high circulation of money to the public. There's basically no high circulation of money to the public. And there's no high circulation of money to the public. There's no high circulation. And lastly, we can talk about selective, what we call selective credit control. Selective credit control. One of the reasons why we have inflation being high is that when there's a lot of money in circulation, when there's credit available to all sectors of the economy, then you know that can lead to inflation because there will be money all over. There will definitely be money all over, and that leads to what you call inflation. But basically, during inflation, the government through the CBK will do what you call selective credit control, where credit will only be given to a selective sector of an economy, to a selective sector of economy. And that will be basically a productive sector. We can talk about productive only to a productive sector. We can talk about a productive sector. So when that happens, when you have the credit being selectively given only to a productive sector, this reduces, we'll say that this controls the inflation. This controls the inflation, stroke circulation, stroke high circulation of money, high circulation of money to the public. That basically controls high circulation of money to the public. And lastly, as an additional, as a bonus one, just to understand this deeper, we can talk about what we call the cash ratio. I just explained it, cash ratio. So we know that particularly when there is high circulation, of money in the economy, what basically the CBK, the government through the CBK does is that they increase the cash ratio. That will reduce circulation of money. And hence, by doing that, they reduce inflation. But again, also of essence, of importance is to understand that questions will not only be touching on this. We can have questions that will basically touch on even fiscal policy. So it's important to understand what a fiscal policy is altogether. Apart from the monetary, it is also very important to understand what we basically mean by a fiscal policy. That is how we particularly handle that question. We'll pick it on the last question. That is last question, April 2024, economics, the last question, that is 7 Roman D. Outline 3 measures that developing countries might use to promote agricultural production. Outline, that is D. Outline, 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 what we call 3 measures that developing, what we call developing countries might, developing countries might use to promote agricultural production, to promote agricultural production. Promote agricultural production. So when you talk about this particular question, again, it's also more of a general question. When you talk about factors that foster or promote or encourage agricultural production, we know that the basis, one of the major backbone of an economy in this developing country is agriculture. Still, majority lies on agriculture, not much of the industrialization. So again, I say that this is a very much open question. When you ask such a question, we can say one of it is reduce taxes on agricultural, reduces the taxes on agricultural input. So you make agricultural input, and this encourages production. Then you say adopting an irrigation scheme, adopting irrigation schemes to overcome adverse weather condition like drought. Adverse weather, to basically overcome adverse weather conditions. To overcome adverse weather condition. Adoption of irrigation scheme to overcome what you call weather conditions. And you can talk about developing infrastructure, what is in the developing countries. I explain particularly this. Why is infrastructure very important? Some of the challenges and why we have not spurred is because of infrastructure. You find the roads, particularly the roads from the industry to the markets, are not very poor. So with that, there are delays in terms of exportation and that. So when you develop infrastructure, that in turn promotes what you call agricultural production. But I say that this is more of a general question. We can talk about a number of things. We talk about investing in research so that you can come up with better quality of products, investing in research. Again, we can also give loans to entrepreneurs, loans to entrepreneurs for those that actually wants to engage in farming massively. The government can offer loans to such. But again, also research is also very important into coming up with better qualities of products in order to invest in. That is how we particularly touch on that very question. That is question 7D, and that marks the end of that paper. Goodbye. We see one another in the next session.
Welcome to our today's session. Today we are looking at question number 3, Management Accounting, April 2022. Question number 3 reads, discuss 4 challenges that you are likely to encounter when installing a cost management system. So what are the challenges that one can encounter when installing a cost accounting system? Remember, you need to understand the qualities of the cost accounting management system for you to know the challenges that are likely to be incurred. But I'll go straight to answer the question. This is question number 3, part A. Challenges to be encountered One, you may have lack of support from the top management. Two, lack of cooperation from the staff. Three, we have a lack environment objectives. So the main motive or intention of a cost management accounting system is it must be relevant and therefore be able to provide relevant information which the management can use for decision making. But when the installment process begins, there are some times when that process may have challenges, and some of the challenges is we may have lack of support from the top management. It is the top management that can facilitate or ensure that the installation of that system is done in the proper way, ensure that the other staff also cooperate so that the system is installed effectively. So if we have lack of support from the top management, it may be a challenge during that process. The Roman 2, lack of cooperation from the staff. Sometimes if that installation of the system is something that maybe is to bring some changes, some staff may resist that change, and when they resist that change, they will not cooperate, and therefore, like when it comes to training, they may not will drag the process of installation. Then changing environment. Sometimes we may have technological changes within the economy. Sometimes we have some systems that may become obsolete after a very short period of time. And because of that, when we are installing the system, you may not be able to detect, like it's a factor that is beyond the control of the installer to know whether we'll have future technological changes or not, which is a challenge. Then number 4, difference in lines of authority. This happens where we have people that are engaging in the process, but they have to report, or reporting is to different authority or authoritative people who have to ensure that ABC is done. And if you do not know your line of authority or where you are to report to, or maybe we have long procedures, then they may delay installation of that system. Then finally, we have lack of clarity of the objectives. What is that system meant for? You need to understand that for you to ensure that you make that system to match of the business. So if there is no clarity, then you may not be able to tell if that system will be a proper one. Of the question, you are told that the following information is derived in relation to Baridi Co. Limited. The annual demand of its product, branded D, is 30,000 units. The ordering cost per order is 2,500 shillings. The holding cost is expressed as a percentage of the purchase price at 20%. The following price ranges are given with their respective quantity. So you've been given a table showing the range, the quantities, and the question is advise the company on the quantity to purchase. So again, to answer this question, we have different approaches that we use to advise the management that wants to buy a quantity that is above the economic order quantity. And therefore, when you look at this question, it is simply referring to a multiple price approach. So it is not a one price approach, but it is a multiple price approach. And therefore, how do we advise the management where we use multiple price approach? The first step is calculate the economic order quantity at the current situation of that farm. So we need to calculate the economic order quantity of that farm before we incorporate any quantity. So how do we calculate economic order quantity? Simply the square root of 2D C0 over CC, where D is the annual demand. So this will be equal to the square root of 2 times. D is referring to the annual demand, and we are told that the annual demand of its product is 30,000. So multiply that by 30,000. CO is referring to the ordering cost per order. You are told that the ordering cost per order is 2,500. Then divide by. CC is referring to the carrying or holding cost. And you are told that the holding cost is expressed as a percentage of the purchase price at 20%. So we are to get 20% of the purchase price, but we've not been given the purchase price. But if you look at that table, we have range 1, quantities 1 to 3,000, and the price is 21. So where no discount is given, it means that the goods will be purchased at the original price, and therefore to know the purchase price is from that range where the farm is buying between 1 to 3,000 units, and that is 21 shillings. Then simply solve it. When you solve this, you'll get 5,976 units. So this is the current economic order quantity at which the farm is placing order. Also need to calculate the total cost. How do we calculate the total cost? Total cost equals annual demand. It is annual demand. So I'll give the formula D over Q times CO plus Q over 2 times CC plus PQ. To the annual demand, Q is referring to the order quantity. For our case, the order quantity is the economic order quantity, and then CO is the ordering cost per order. So when you take this, is the same as number of orders times the ordering costs per order plus Q is referring to the order quantity divided by 2, which gives us the average stock, times the holding cost per unit per annum. Then plus cost. And the purchase cost is simply the cost of acquiring the product, which is simply the price per unit times the quantity. So to substitute this with figures, we'll have 30,000 units divided by the EOQ, which is 59 units,